Hello everyone. The last few months have been a volatile period for equity markets in India and globally. While the month of March 2025 saw the Indian equity markets close with around a 4.7% gains for the Nifty, everything has been topsy-turvy in the beginning of the financial year FY26. The entire market focus has shifted towards tariffs and trade wars unleashed by the US. The US has announced a 10% baseline tariff effective from 5th April, along with individual reciprocal tariffs for countries, some as high as 49%, starting from the 9th of April. The reciprocal tariff rate for India stands at 26%, while the rate announced for China and Vietnam stand at 34 and 46% respectively. These tariffs are on top of already existing tariffs. US has imposed mass tariffs like this twice before in history, in 1828 and 1930. Both those instances resulted in recession in the US. Now, while we will have to wait and watch as to see how the impact of tariff plays out in the current form, it is likely that tariffs will lower US GDP growth and result in higher inflation. The impact will eventually come in the form of lower US discretionary consumer spending on the back of higher inflation, as well as eroding wealth effect, which can have medium-term consequences for the economy and the world. Now, how the US Federal Reserve responds to this economic situation is unclear. However, bond yields in the US have fallen, with the US 10-year yield now below 4%. While India seems to be protected from a competitive point of view, as tariffs on several South Asian economies that compete with India on various items that India exports are even higher, it will, however, have to be evaluated in the medium term depending on how India seeks to capitalize on the situation. In the near term, it is likely that countries would negotiate with the US on bilateral terms or could even respond with currency weakening. While there is a lot of uncertainty, one thing is for sure, that this is not the end as far as tariffs go, so stay tuned for further developments. On the domestic front, real GDP growth in India appears to have bottomed out, with Q3 FY25 real GDP improving to 6.2%. There has been some pickup in government expenditure, improvement in power demand, and rural demand. Improvement in systemic liquidity, with RBI taking steps to improve the same, bodes well for demand. On the other hand, urban consumption demand remains muted, and the external sector risk, especially from the capital account, remains. On the earnings front, Nifty EPS estimates have been moderately down in the past quarter. And in this context, earnings delivery over the next few quarters becomes important. At March 2025 end, the Nifty was trading at a price to earnings multiple of 19.5 times FY26 expected EPS, with consensus estimate for earnings growth of single digits for FY25, followed by low teens earnings growth in FY26. Large caps continue to be better placed from a risk-reward perspective. Large caps are now trading slightly below their historic average valuations, while mid and small caps are still trading at multiples that are somewhat higher than their long-term averages. Hence, delivery of earnings becomes even more critical, especially for mid and small caps. Our approach to investing in mid and small caps remains bottom-up in nature. We would look at buying high-quality companies that are today available at reasonable valuations, where there is visibility of earnings. From a sectoral perspective, we would focus more on those sectors which derive demand from the domestic economy. In that context, we are overweight on large private banks, where valuations are reasonable, discretionary mass consumption sectors which benefit from the recently announced tax cuts for the middle income segment, as well as healthcare, specifically hospitals, and the domestic formulations business. Remember, in the near term, there are many moving parts, all of which could have a bearing on equity markets. Hence, it's likely that we would have to navigate near-term volatility in line with what's happening globally, even while the medium-term structural drivers for Indian equity markets remain intact. For our investors, we would recommend that you remain disciplined in your investment approach with a long term time horizon, with an eye on asset allocation, depending, of course, on your risk appetite and your investment goals. Stay healthy. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.